Hi everyone, and welcome to the webinar. Thank you for your patience. Just a small issue to do with the audio, and also I'd forgotten to put the disclaimer up, which is not on. So before we start the session, may I draw your attention to the disclaimer that I know you can see on your screen. As you know, trading can be a very risky business, so please don't ever think of using money that you cannot afford to lose. And as always, for those of you who are coming along for the first time, we will be looking at the charts through the prism of volume price analysis, which is essentially the relationship between price action and the volume, really to see whether the move that we are seeing on the chart is genuine or not. And when it isn't genuine, we get a lot of anomalies, and with those anomalies usually come either pullbacks or reversals. So, but the best way to see the to VPA in action is to have a look at the chart. What this book also has now, it has an accompanying book with some worked examples of the methodology, and it's bundled up on Amazon as a box set, but it's only available on Kindle. There is a version for the Forex market as well, but this one has primarily stocks, the indices, and some commodities as well. I think there's some treasuries in there, but to be honest, as I've said before to those of you who come regularly, it almost doesn't matter what the ticker is. The methodology is applicable across the markets and across the time frames. Now, what are we looking at today? I'm going to be focused on Forex, but part of what we're going to be covering is we're going to be covering some of Wyckoff's trading laws. One of them in particular, the second, which is the law of cause and effect, and I've got that to a Euro CAD move that we've had this morning. But before we do that, let me just have a quick check on the news. I think we're pretty much done with the news. As you can see, we're coming to the end of the trading month. It's also the end of the quarter. We all know the state that the markets have been in over the last few months, given the virus. They're a little bit very nervous at the moment. Obviously, yesterday we had that big correction, which we have been talking about. If you've been coming along to these sessions, you only have to look at the slower time frame charts to know that there was a correction coming. It was only a case of when. But if you use the VPA methodology and you have some of our quantum indicators, in particular the Camarilla indicator, and I have that on the NQ, the levels were there. It was tested once, didn't go through, tested a second time, and bang. And yesterday was a massive day, certainly to the short side. And we can see here, they're trying to recover a certain amount of poise, if you like. It's been a bit of a scare, a bit of a shakeout. The market doesn't want to fall, wants to keep, the good news going. The news is being dictated, really not by the fundamentals, but by what is happening on the virus. And all this, so you have all this, we talk about volatility. So this is causing the markets to perhaps move erratically, bigger swings than usual. But when you're day trading, and it doesn't matter what you day trade, you really have to get a grip on the volatility that characterizes the market or instrument that you are trading. Now in Forex, I'm going to show you later on how you can identify when, by volatility, I mean two aspects of volatility. One is in terms of the number of pips that you can expect in a trading session. So a pair will move, at what time of the trading day or a 24-hour cycle will it likely to move the most, and I'll show you how you can find that information. It's also in our Forex program. We actually show you how you can calculate that yourself. You also have to apply that to stocks as well. Anything that you trade, you do get a feel for these things the more you trade a particular market or instrument. But if you have forewarned is forearmed, as they say. So if you know in advance that you're coming up to a particular time in the session when the instrument that you are trading is likely to be moving more than usual, then all the better, and you then apply the methodology, and if you have our indicators as well. There's also, so that's volatility in terms of how far something is, is likely to move. Then you have the volatility that's going to be driven into the market by events. Events, I mean, obviously fundamental news. You've got news about the virus, but tomorrow, for those of you who are in stocks and indices as well, it's just something to be aware of. This was on CNBC. It's going to be a big volume day tomorrow, because there's going to be a rebalancing in in the large cap of Russell 1000, and apparently it happens once a year, and it's one of these events that, if you are into stocks and indices, then you will be aware. It's like quadruple witching. That was last week. That caused a lot of volatility. So volatility is not just the extent to which a market or instrument is likely to move at a given time, but it's also what is likely to impact, whatever you are trading, and tomorrow seems to be one of those days. So it should be very interesting, and certainly if you are day trading stocks, then this is something to be aware of. Now, the implication of this, the implication is in your position sizes and the length of time that you stay in a trade, and we touched on this last week. In other words, if you are going to trade, say, a stock that has high beta. Beta is the metric that is used to establish whether a stock is volatile or not. If it's got a low beta, it's low volatile. If it's the number is 1, if it's higher than 1, it's deemed to be more volatile. It moves more. Your risk on that trade, if you are going to go after high beta stocks or high beta instruments, your reward is going to be greater, but your risk is going to be greater. So you have to be aware of that. And one of the ways you control that is through your position sizes and and perhaps scaling out or scaling in. You have to decide how you want to play it. If you find something is too volatile for you and you really can't take, it's beginning to affect you, then you have to go and look for something that perhaps isn't so volatile. You can afford to be perhaps a little bit more relaxed. It's not going to move as much. Maybe your return is not going to be as much, but emotionally you are going to feel much better. And I'm going to move over to David, and he's going to talk about the indices in a little bit more detail and volatility and what to do, what strategies you can adopt when the market is very volatile. What are the signals you're going to see on the chart? What is VPA going to tell you? And if you've got our indicators, what our indicators are going to tell you, because we actually have a dedicated volatility indicator which fires in real time and tells you, hey, there is volatility has entered, perhaps unexpectedly, perhaps as a result of a news release, in a way you don't need to know. As soon as that indicator hits your chart, you know that that move is outside of the average true range, and you had better beware. So I'm going to pass over to David, and then we're going to come back and go through the Forex bit of the webinar, looking at volatility, Wyckoff's second law, and looking at, in particular, I've got the Euro CAD. It's something that I've been focused on. I've been focused on since this morning, actually.